Welcome to the Upside Journal podcast. In 2026, the traditional venture capital model is facing a paradox: dry powder gridlock and extended exit timelines. But there's a hidden alpha: immigrant-led diaspora business networks. Today, we're unpacking how these syndicates are building a structural flywheel for AI and climate ROI. So, to really grasp this massive shift in venture hegemony, you have to look at what domestic institutional allocators are dealing with right now. High interest rates, stretched out exit timelines. Honestly, they're practically paralyzed. It's like a frozen anchor. But on the flip side, you have these elite, highly coordinated cross-border investment syndicates moving incredibly fast. They are generating predictable, counter-cyclical returns that single market funds literally just can't touch right now.
Here is our institutional briefing architecture for today. First, uncovering the hidden alpha. Then, the talent to de-risking flywheel. Third, the climate and supply chain advantage. And finally, the structural jurisdictional edge.
Let's dive right into part one, uncovering the hidden alpha, bridging capital and global talent.
The structural edge we're talking about here is what we call asymmetric information verification. Think about an investor sitting in London or Silicon Valley, who is also deeply embedded in, say, an active Taiwanese, Indian, or Nigerian tech diaspora. They have dual market fluency. They just inherently understand the regulatory, educational, and cultural landscapes of both their origin and destination markets. This completely bypasses the usual operational friction. It allows for rapid, dead-accurate due diligence that a traditional domestic-only fund simply cannot replicate.
And the proof is right there in the data, 42%. Immigrant-led tech enterprises are now driving over 42% of cross-border patent applications in generative infrastructure and grid-scale clean tech. They are literally building the foundational IP of the future economy, backed by syndicates who know exactly how to navigate cross-border operational risk. Translating that IP dominance into financial reality, we're looking at a 16% average net IRR in deep tech. That is driven by winner-takes-most dynamics in these structurally advantaged verticals. I mean, that absolutely crushes the 10% IRR we typically see floating around in traditional software.
Oh, and it actually gets better. These cross-border networks are outperforming their single-market competitors by a massive factor of 2.4x when it comes to time to liquidation. Because they bypass all that regional friction from day one, they scale faster and they exit faster. It's an entirely different risk profile, and traditional funds are missing it entirely.
Honestly, it's no surprise we're seeing this massive migration of capital. $14.2 billion was deployed into early-stage AI and localized climate resilience frameworks in just the first half of 2026 alone. High-skilled diaspora communities have officially shifted gears. They're moving way beyond simple liquid asset preservation and diving aggressively into early-stage technology syndication.
Moving right along to part two, the talent to de-risking flywheel, scaling the AI frontier.
There's some really compelling academic validation from Berkeley Haas proving this structural shift. When you compare native-only founding teams with native migrant teams, the native migrant teams have a huge multiplicative advantage. We're talking superior access to diverse labor pools, the ability to attract more successful VC capital, and a much smoother time navigating complex international regulatory structures. They get to leverage the global networks of the migrant founders right alongside the domestic expertise of the native founders. It's basically a best-of-both-worlds scenario.
So how does execution actually look? It comes down to a 4-phase syndication pathway. Phase 1 is asymmetric talent sourcing, basically grabbing elite talent before traditional venture scouts even realize they exist. Phase 2 is distributed due diligence, spreading the evaluation load across multiple jurisdictions. Then Phase 3 is global enterprise scaling, where network executives step in to secure international pilots. Finally, Phase 4, reinvestment. The successful founders become LPs to fuel the next generation. This pathway completely de-risks deep tech internally, long before institutional money even gets a seat at the table. And what this cross-border tech flywheel creates is an incredible speed advantage. Product market fit is happening 30% faster for these diaspora-backed startups. The reason why is pretty straightforward. Enterprise validation isn't happening in a silo. It's happening simultaneously across multiple continents, all thanks to those distributed corporate structures.
Okay, Section 3, climate and supply chain advantage, margin resilience, and physical infrastructure.
Look, if you try to scale heavy physical grid infrastructure purely through domestic supply chains, you're going to hit a wall of severe regulatory hurdles and wildly inflated material costs. But when you utilize cross-border supply chains driven by a diaspora network,
founders can plug right into deep-rooted industrial networks in, say, East Asia or Latin America. You secure secondary supply lines and localized approvals so much faster. It creates this massive strategic defense mechanism we like to call margin resilience.
The hard data from MIT really backs this up too. By utilizing these cross-border manufacturing syndicates, startups are reducing capital expenditure by up to 45% during that critical scaling phase. I mean, think about it. That level of efficiency directly impacts valuation multiples and makes your exits incredibly predictable.
Which brings us to part 4, the structural jurisdiction edge, insulating against the macro. Because these investments are so deeply rooted in high-trust, active network orchestration, they're fundamentally insulated from localized herd behavior. It acts like a protective shield. They are way less susceptible to those sudden valuation corrections we keep seeing in mainstream venture ecosystems, mainly because they bypass regional operational friction right from day one. This makes these syndicates highly counter-cyclical and incredibly resilient to macroeconomic downturns.
Ultimately, it all boils down to this reality. Capital itself is highly commoditized in 2026. What is truly scarce right now is access to trusted, high-conviction deal execution. And that's exactly why the future of tech investment relies on active, curated ecosystems that intentionally bridge institutional allocators with the actual builders of these cross-border syndicates.
So the question is, will you align your strategy with these global networks, or just watch the new venture hegemony leave you behind? Capital is commoditized, but high-conviction execution in cross-border tech is scarce. We are tracking the syndicates defining this new venture hegemony. Subscribe to the Upside Journal for institutional-grade market signals. See you in the next Daily Drop.